to say the least, 2022 hasn't been the best year for U.S. stocks, at least not so far. The S&P 500 is down almost 20%, and U.S. stocks as a whole haven't had this bad of a first half of a year in over 50 years. So a lot of people are saying, well, this might be a great time to buy, right? You want to buy when people are fearful. You want to buy when stocks are low. You can get more for your money. But is that the correct assumption at this point in time? Is this a good time to buy as a long-term investor? Well, we're going to go in and look at the charts and look at the data. I'm going to first show the fundamental perspective of U.S. stocks and whether or not they're undervalued and at a price point where it would be a good long-term buy. And then we're going to go in and look at the charts and see what the technical picture is showing us as well. And I'll share my opinions on both of those. And lastly, I'll talk about Bitcoin and give my update on its chart, which is now has been tracing out a very big bearish pattern. It's down about 75% from its all-time high. And is this a time to buy, or are we in the middle of an ugly bear market that's going to have big swings up and down? So if any of that sounds interesting to you, then you might want to stay tuned. All right, so first let's look at the fundamental side of U.S. stocks right now. Is the U.S. stock market at a good price to buy in the long term? And I think one of the best ways to answer this question and consider the situation is by looking at the Warren Buffett indicator. I've talked about this metric before and have shared it on this channel, and this is a great time to go ahead and look at this when a lot of people are saying, hey, this might be a great time to buy. So let's take a look at this. Again, this metric compares U.S. GDP, or gross domestic product, basically the goods and services that the U.S. is producing every year, and comparing that to the Wilshire 5000, which you can think of as the entire market cap of all the U.S. stocks combined, right? So you're basically comparing all of U.S. stocks, the valuation that those are currently at, and comparing it to something that's very applicable to the U.S. economy, that's like a good proxy of how much wealth the United States is creating in a year. And so you're comparing that on those two numbers, and you're getting a ratio. And depending on that ratio, you can get a relative sense of how overvalued or undervalued the U.S. stock market is. And Warren Buffett has been known to say that this is one of the best single indicators of getting a gauge of how overvalued or undervalued the stock market is, whether or not it's a good time to buy or not. So when one of the greatest investors of all time mentions that, you definitely want to open your eyes to that and look at it. And so this indicator is looking at U.S. stocks as being significantly overvalued when looking at the traditional ratio. And when including the Federal Reserve's balance sheet in the numerator before being divided by gross domestic product, it's considered modestly overvalued, right at the cusp between modestly overvalued and significantly overvalued. Now, again, I've talked about my perspective on the Federal Reserve and how I don't really think the Federal Reserve's actions directly impact stock prices, or that that really makes much of a difference. Again, they're just adding bank reserves onto their balance sheet, and they're doing what they can to try to influence interest rates to keep things afloat. But that doesn't necessarily have any direct effects to stock prices based off of their balance sheet construction. So that's my opinion on that. But again, if you feel that the Federal Reserve has a big influence on stock prices directly, then you can look at this ratio that includes the Federal Reserve's balance sheet in the equation, since the Federal Reserve has not been historically has not historically intervened as much as they have today. And so you might think that today is different. And so if you want to look at that ratio, then that's there as well. But regardless, the stock market is fundamentally overvalued when looking at this metric, no matter how you construct the metric. And right now, when looking at the traditional ratio, it is likely to return about 0.7% per year from this valuation on average. And when looking at the Federal Reserve being included in the equation, the stock market is likely to return about 2.4% per year. So pretty low returns. And that I think is pretty generous, especially when taking into account the technical perspective, which I'll share in a minute. But it's really important to look at these charts. I'm going to put this link in the description below so that you can continue to keep tabs on this metric as things progress, as the market continues to afford more information, because this, I think, is the single best indicator to look at to really give yourself a good sense of when it's a great time to actually enter the market as a long-term investor. Again, this is not for trading. This metric can obviously get very extreme both ways, and it's not an indicator of anticipating market directions or anything like that in the short or medium term. But it is a good idea that it gives you a good idea of whether or not stocks are actually overvalued or undervalued. So here we have the chart that shows Wilshire Total Market Index here in blue, GDP in green, and also shows the assets on the Fed's balance sheet in red. And we can see that the Wilshire 5000, the US stock market, has been way above GDP for the last about 10 years. And it's gotten more and more extreme. And just since 2022, we've started to come down as the market is corrected. And so we're starting to get a little bit closer to GDP. But again, when we look at it, there's still a massive gap here, and it shows that US stocks are still much more overvalued compared to GDP, which again suggests and is why above it shows that stocks are extremely overvalued. But also the Fed's balance sheet has increased. And so when you include the Fed's balance sheet into the equation, they're only modestly overvalued. But regardless of how you skin the cat, you still get to the same conclusion that they are overvalued currently. And here are the two different metrics being shown. The bottom is where you include the Fed's balance sheet in the denominator, and the top one is where you just have the total market cap divided by GDP. So you can see that both of these are substantially over 100% of GDP, while this one, the one with the Fed's balance sheet, is only at 118%. It's a little bit closer to fair value, but still it's pretty overvalued. And right now, the total market cap divided by GDP, the traditional metric, is at 161% of GDP. So significantly overvalued. Now, let's get a relative sense of where we are historically. Where we sit right now with the traditional metric is still above the peak of the dot-com bubble. I'll say that again. Right now, stocks are still more overvalued, according to this metric, than they were in March of 2000 at the peak of the dot-com bubble. Stocks here were 142.9% of GDP, and currently they're at 161.9% of GDP. Now, when you look at comparing it to the Fed's balance sheet, if you use this equation, they're not quite as expensive as they were back in the dot-com bubble. Here, they were at 135% at the peak. Right now, they're at 118%. But again, that's not a big difference, even if you subscribe to the narrative that the Federal Reserve has that much of an influence directly over stock prices, which again, I hold that with a very light grain of salt, but that's just my opinion. But regardless, again, it shows a very overvalued picture here when looking at US stocks, even though they're down about 20% this year, because a lot of people are like, oh my gosh, they're down 20%. That's great. They're cheap. But again, if they fall, 30% in the next 6 months, now they'll be relatively cheap then. And if you look back to now, 6 months ago, when they were down 20% from the peak, you'd be like, oh, but that was still expensive compared to now, right? So it's all subjective. So it's really important to not play that game, because trust me, I've played that game before when I was less experienced. And it's not a fun game to play. And so this gives you a much more accurate bird's eye view of where we are, especially when zooming out and looking at the bigger picture. So here, if we zoom out, when are the best times to buy stocks? What is the pattern here? Well, the pattern is very consistent. And if we had even more data that went back before the 1970s, you would get a lot of the same picture. It's a pattern that has been going on forever, which is where stocks go from being fairly valued to overvalued to undervalued, and then back to overvalued, and then back to undervalued. And these are big extremes. It's not just slight. We can see here that stocks were around 30 to 40% of GDP, and throughout the bear market that started in the early 70s and went all the way through the 80s, and then towards the mid 80s, we started turning up, and this ratio went all the way from the low 30% all the way to the 130 to 140% levels. And that's when they became very overvalued, and that led to a double dip recession from 2000 to 2009 that included the dot-com bubble and the financial crisis. And they ended up going to about the low 70%. So they became significantly undervalued. Then they went back to being overvalued above 100% in 2007. And then when the housing bubble burst, that led to stock prices tumbling all the way down to under 50% of GDP. And they became very undervalued again. And now we are going back. We crossed the fair valuation around the mid 2010s, and now we are extremely overvalued. Now, the question that you have to ask yourself is, do you think that stock prices are going to go back to fairly valued and then all the way back to overvalued? Or do you think that the pattern that's been going on for the last, let's say, 100 years is going to continue, where after they become overvalued, which is the same thing if we had more data and looked at the 1930s, we look at the 1910s, 1920s, and then all the way into the late 20s, they went from very undervalued to very overvalued. And then the Great Depression brought them right back down to undervaluation. Then when we look at the 50s and 60s, they got back to being overvalued into the late 60s. Bear market that led into the 70s. And here we can see the chart all the way back down into the early 80s. And then from being undervalued, they went all the way back to being overvalued into the early 2000s. So this pattern has been going on for a long time. It's not that stocks go from overvalued to being fairly valued back to overvalued. It always flips extremes, from overvaluation to undervaluation, from undervaluation to overvaluation, and so on and so forth. So this is a long-winded way of saying my opinion on where we are going is that we're going to go to undervaluation before we go back up in a significant bull market. And I think this bull market, from a fundamental perspective, makes a lot of sense that it is going to take us back to undervaluation, because that's what's happened in every bear market. We've always gone back to undervaluation when looking at the Wilshire 5000 compared to something tangible, something that has historic data like GDP. So in my opinion, I think we are going to be going back to undervaluation. What is undervaluation? Well, we can look at this from 2009. We got under 50% all throughout the 70s and 80s. We were well under 50% into the 30s. So I think a modest projection would be looking at 60 to 50% and below as really being the gauge. If you're someone that subscribes to the narrative that the Federal Reserve has a big impact, then you might only be looking at this blue metric and saying, okay, well, when stocks get back down to around 50% of GDP, according to the total market cap divided by GDP plus total assets on the Fed's balance sheet, then that's when I'm going to look to get in to my long-term position. That's completely reasonable. But yeah, I think this is a really, really awesome metric that's like provides so much clarity. Like, hey, US stocks are down, but if I'm a long-term investor that's got a much wider time horizon, stocks are still very, very overvalued. And personally, I'm not a big fan of trying to buy something that is overvalued to sell it at an even higher valuation. I'd rather buy something cheap and that's undervalued and then sell it at a higher price. But you haven't had a lot of those opportunities because things have been very, very expensive for a long time. I mean, look at real estate, how it's just continued to hang on. But here, that is my opinion on this. And I think this data is very powerful. There's a lot to read on this site, so definitely check it out if you're interested. And again, I'm just going to show this real quick. That gives you an idea of these ratios and what they mean. The idea is below 77%, when the total market cap is below 77%, stocks are considered undervalued. They are considered fairly valued between 100 and 120%. Above 122%, they're considered modestly overvalued, and above 144%, they are considered significantly overvalued. And this is when looking at that blue line. I think it's the blue line. No, it's the, what is it? The green line. This is the traditional metric, total market cap divided by GDP. So when it's above 144%, that's like bubble territory, significantly overvalued. That's what they were. Not even at the top of the .com bubble, it was at 135%. So that's I think all I have to say about that. If the fact that stocks are still more overvalued according to this metric today than they were at the peak of the .com bubble, I mean, wow, that's crazy. But yeah, this is a really simple, intuitive kind of table here that gives you a good idea of what the overall market's valued at, especially for those that do index investing and that kind of thing. Looking to buy a lot of different stocks, looking at more of the overall price of the US stock market. I mean, this is bread and butter right here. This is good stuff. So definitely check this site out. Again, this is called the Buffett indicator, and gives you a great idea of the relative price, the relative valuation of the entire stock market. So that's the fundamental view of the US stock market. I think it's most important to really get a good idea of that. But now let's check out the technical picture on the US stock market. Where are we at technically here with the chart? I'm going to go ahead and share this monthly chart here of the S&P 500. This is taking a good top-down analysis, looking at the big picture. Here we have the financial crisis, 08, 09. And since then, we've been in this perennial bull market that has just been going on forever. I think that it's very, very likely that we have finished that 2022 was the start of a new trend in US stocks that is going to correct a lot of this price action that we've seen for the last, let's say, 13 years, since 2009. My count is that this is an extended wave 3, 1, 2, 3, 4, and 5. Then we have this kind of triangular pattern, A, B, C, D, E, an expanding triangle. And since the bottom of the COVID crash, we had this massive move up. And the question is this massive move up? And I think there's a very, very strong argument that it is complete. And the main reason I say that, and we're going to zoom in here to this big move up, this fifth wave. This has been the one that I've been tracking for a long time on this channel. And it does look like it's very likely complete. And there's multiple reasons for that. The first one is that this pattern over here does not look proportional to any of the corrections in this structure. And so this looks like a completely different structure compared to this. Now you could say, well, maybe this is all just one wave of 5, and this is the second wave of 5, and then we're going to go up in the third wave of 5. The problem with that is that wave 5 would become disproportionate to the rest of the structure preceding it all the way since 2009. Usually wave 5 is somewhat proportional to wave 1, and wave 1 only lasted about 11 months, from March 2009 until April 2010. So that doesn't seem very reasonable that wave 5 would last like if wave 1 lasted 2 years. Let's say wave 1 is about 20% of the structure, and that's pretty conservative because wave 3s are usually the most extended. That would suggest that wave 5 would last 10 years at least. Yeah, that wouldn't really make a lot of sense proportionally unless there's a whole different count going on. So that's why I don't think it's as likely that this is a wave 2 of 5 and that we're going to be going up in a very steep manner for the next 8 years. That's one reason. And another reason too is that if this is a wave 4, if this, let's say, if we subdivide this pattern into 5 waves, then we say, okay, well, this is 1, this is 2, and this is all 3, and we say this is 4, and then we're going up in a 5 eventually, and we take this down to a lower degree of magnitude, then it would look that wave 4 would be disproportionate to wave 1, even though we have not broken this line here, the top of wave 1, which is a rule in Elliott wave theory that wave 4 cannot violate wave 1. So technically this could be valid, but again, it does not have the right look, proportionally speaking, where this would be a wave 4 and this would be a wave 2. So given that, I don't really like this count at all. And so my opinion on this is that it's much more likely that we've already traced 5 waves. You could count it in a couple different ways, but it's not that relevant, given how large and also long that this correction has taken so far. It looks like this is a whole different pattern. The pattern isn't very clean, to be fair, from the all-time high. It doesn't look extremely impulsive yet, but the risk is definitely there that it could really intensify to the downside. Now, if we make a new all-time high, then it's going to be a bit dicey, the pattern, and that would be a pretty bullish development. I guess this could be a wave 4, but if it's there, it just looks way disproportionate to the rest of the structure. So I would not be quick to call that a wave 4. But anyways, it does look like this is a complete 5-wave pattern, whether you count wave 3 being here, wave 3 being here. This last wave isn't the cleanest, but it does look like this is a complete pattern, and it's very likely that the bull market since 2009 did top here in late 2021, early 2022. That's kind of the perspective I have right now in U.S. stocks. It's not an easy market to trade. It's not an easy market to anticipate. But again, the bigger picture seems to be very bearish. And I think that would become even more apparent when this line is violated here around 3,600. It would then break that pattern. And the only other viable pattern would be saying that this is all wave 1 of 5, 2 of 5, and then we're going up 3 of 5. And I would put that at a very low likely scenario. So that's my perspective right now in U.S. stocks. Very bearish. We could be entering a pretty substantial bear market, given how long the preceding bull market has lasted and how overvalued stocks were at the peak. It could have a very long slide down to basically respond to all of that bullish price action for such a long time. When things go up, they must come down at a certain point. And we can see that case in point with Bitcoin's chart. So let's go ahead and check out Bitcoin. Got that right here. Here's the Bitcoin weekly chart. Man, oh man, has it been ugly. So in my last video, I was anticipating this to be some kind of sideways wave 4, and I was anticipating one more move up to complete the bull market. Again, zooming out, it looks like it's the 5th wave of a bull market that's been going on since 2009, very similar to the U.S. stock market, except the U.S. stock market could be entering an even more severe bull market or bear market because of like the 100-year chart. Bitcoin's only been around since 2009. So this is the first bear market of this magnitude potentially for Bitcoin. So that's a pretty big deal. Again, this is kind of the pattern that I was looking at going back to 2018. And I was looking at this being a sideways wave 4 before we had another wave 5. Obviously, that did not happen. And when we broke below this level, it broke that pattern. This was 29,000. When we broke below that, and it was really this level right here, 33,000, because I was calling this a triangle pattern, A, B, C, and I was calling this D, and I was looking for a move that did not violate 33,000. When we broke below 33,000, that broke that configuration of the triangle pattern. And when it broke below 28,000 here, it broke every potential configuration of a triangle pattern. And that's when I became more bearish on that hey, the bullish pattern looks like it's broken. And I was not really sure of the pattern that was tracing out. And it's now more likely, very likely, that this is the count here, where we had a very brief wave 4. Again, this did not look to be enough of a wave 4, given that it was about 3 times shorter than wave 2 from a time duration standpoint. That looks like it is the case. Now, you could make an argument, and it's kind of similar to the S&P argument that is not really that pretty, but it's much more viable in Bitcoin compared to the S&P. But since wave 1 has not been violated since the 2018 impulse, you could technically say that this is all a wave 4. Again, when this breaks, and it's very evident that we're in a bear market, that we've been in a bear market, and that we are tracing the largest bear market since 2009. This is a different magnitude, should be larger than all the previous Bitcoin bear markets, given that it's correcting not just 3 years of bullish price action, but 12 years or 13 years or whatever of bullish price action. But again, not 100% clear. This is the preferred account where we did break below and we're starting a bearish impulse to the downside. But that is a potential alternative count where this is a wave 4 and a wave 5. Again, it's not my preferred anymore, but I'm going ahead and covering that potential scenario so that, I'm not closed off to any ideas. But regardless, it looks like we've had 3 waves to the downside. 1, 2, 3. It could also be A, B, C, and then we have a 3-wave move up and then another 3-wave move down. It could trace out in a lot of different ways. Bearish patterns are difficult to anticipate. You need a lot more context to go off of. And so far, we just know that we're in a bearish trend, but we don't know if this is going to be a 5-wave pattern or a 3-wave pattern. So far, we've had 3, we're going up, and what could be a 4th wave before we take out another low. And that's kind of what I'm waiting to see here. If we do go straight up here and we break above this high, even though that would look like a bearish or a bullish scenario, that would kind of invalidate this potential ABC as being a 4th wave, because something about expanded flats, which that would be an expanded flat, A, B, C. Wave C's are always 5 waves. And if this only turns out to be 3 waves, then that would not really, that wouldn't really tied well with the idea that this is a 4th wave. So given that, that'll be interesting, and it might be a pretty ugly, zigzaggy, overlapping bear market. But the real question is, regardless of if this is a 4th wave, which is very unlikely compared to the scenario that we've already started a bull market or started a bear market. The question is how low is Bitcoin likely to get in this impending or developing bear market? And usually Bitcoin falls pretty deeply, 85 to 90%. And that's what I'm expecting over at least a year's time. But if this is the larger bear market, then Bitcoin's probably going to have a bear market that's probably about 3 times larger in terms of duration than these bear markets. And that could easily lead us into 2024 to 2026. It could go much longer than probably people are thinking. Obviously, there are going to be big moves up and big moves down, as you can always expect in crypto. So it's not easy to just pick a direction, because it's very volatile. There are big swings in both directions, even if it's whether it's a bull market or a bear market, right? So you always have to be ready for those. But again, I'm doing more updates on Bitcoin on my Twitter and my Instagram. And so if you're interested in shorter term updates on this crazy market, then definitely check me out there. My info is in the description below. But that's my current view on Bitcoin and the US stock market for that. And I would love to hear you guys' opinion on all this. There's so much crazy stuff going on in the world. There's so much to talk about. There's so many, there's so much, but this is definitely an area that I think is important. Our finances are really important, and managing and being in the right financial position just helps us a lot. It's one less problem for us to have or to worry about. And I would love to hear you guys' opinions, where you see the charts going, some of the risks that you see, and I'm sure the whole community would love hearing your thoughts as well in the comments. So please feel free to share them. And if there's any information that you think is pertinent to this topic surrounding US stocks, impending bear markets, lots of risk out there, and crypto, feel free to put it down there below. Thank you so much for watching, and I'll see you guys next time.